If you're trying to decide between XEQT and VEQT, I've got some good news. You probably can't make a bad decision. These are two of the most popular all-in-one ETFs in Canada, and when you compare their performance, they're almost impossible to separate. But there are some important differences once you look under the hood, particularly when it comes to how they're constructed, how much Canada they hold, and tax efficiency. So does it actually matter which one you buy? Let's do this! Let's start with what makes these two ETFs so similar. Both XEQT and VEQT are fund of funds portfolios made up of underlying ETFs that provide broad diversification across regions. The goal of both funds is long-term capital growth. And both are 100% equities, meaning there is no fixed income component. Both are also continuously monitored and automatically rebalanced. So you don't have to manually rebalance your portfolio yourself. In other words, both are designed to give you a globally diversified portfolio in one ETF. So before we get into the differences, let's answer the question everyone wants to know. Which one has performed better? This will probably interest you. One of them technically comes out ahead, but the difference is so small that it doesn't really help us choose a winner. First, I need to clarify one thing when comparing these two funds. XEQT has an inception date of August 2019, while VEQT launched about 6 months earlier in January 2019. So the comparison isn't perfectly apples to apples. You're going to be surprised which one of the two comes ahead long term and why. Year to date, XEQT is edging VEQT by 0.33% as of July 31st, 2026. At the 1-year mark, XEQT is still ahead by 0.08%. The 3-year average annual return is nearly identical at 20.89%. And at 5 years, XEQT is ahead by a whopping 0.03% annually. Since inception, XEQT has had an average annual return of 14.53%, 0.27% more than VEQT. But remember, the inception dates are different. And when you look at the rolling returns, the picture becomes even clearer. The high, low, and average rolling returns are incredibly close. You can really see how close they are when you look at the annualized 3-year rolling returns graph. VEQT and XEQT have both led at different points over the years. So I think it's fair to say that in terms of performance, these two ETFs are essentially in lockstep. Performance doesn't give us a clear winner. So now let's look under the hood. One thing you might notice when comparing these two ETFs is the number of stocks they hold. VEQT holds roughly 13,743 underlying stocks, XEQT 8,379. So does that mean that VEQT is more diversified? Not necessarily. And this is an important concept when comparing two ETFs. Having more stocks doesn't automatically mean you have a more diversified portfolio. Why? Because what really matters is how much of the portfolio each stock represents. This is called the effective number of stocks. Imagine I gave you a portfolio with 100 stocks, but 90% of your money was invested in one Canadian company. You technically own 100 stocks, but your portfolio would still be heavily concentrated and move with that one stock. The other 99 stocks would have little impact. Now, before we continue, let me introduce myself. I'm Mr. Financial, and I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on internet hype. If that's your vibe, subscribe. So when we're comparing XEQT and VEQT, we need to look beyond the number of stocks. We need to look at how the portfolios are actually constructed too. So I mentioned that both XEQT and VEQT are fund of funds portfolios. The underlying funds are passive indices, meaning the managers aren't sitting there picking individual stocks. Instead, they're choosing ETFs that track broad market indices. VEQT holds 4 underlying ETFs, 3 are based on FTSE indices, and 1 follows the Morningstar US Total Market Index, which is a recent change from the CRSP US Total Market Index. XEQT holds 5 underlying ETFs. 3 are based on S&P indices, and 2 are based on MSCI indices. The top 10 underlying stock holdings are very similar between the two ETFs, but there are some stark differences. For example, XEQT is slightly heavier in US stocks among its largest holdings, while VEQT has a somewhat larger allocation to Canadian stocks. You can see this in the individual companies as well. For example, Royal Bank makes up about 2.5% of VEQT compared to just 2.1% of XEQT. But here's where the bigger difference comes in: the underlying regional weights. And that's important because those weights ultimately determine how diversified the portfolio really is and the weighting of the individual stocks. VEQT is a global equity portfolio with a relatively large Canadian home country bias. Right now, it's roughly 30% Canadian equities and 70% international equities. And Vanguard has explained that this higher Canadian allocation is based on its research around what it considers an appropriate home country bias. Importantly, VEQT's regional allocations aren't intended to be fixed in exactly the same way as XEQT's. Vanguard can also rebalance the portfolio at its discretion according to the fund's investment strategy. XEQT, on the other hand, has defined strategic regional targets. The portfolio is approximately 45% US, 25% Canada, 25% developed markets outside of North America, and just 5% emerging markets. These targets are allowed to move within specified ranges. So the important distinction is not which all-in-one owns more stocks. It is better framed as, how does each ETF decide where your money goes? Right now, the differences aren't enormous. VEQT has roughly 4% more allocated to Canada and about 2.4% more to emerging markets. XEQT has about 7.7% more allocated to developed markets. So both are very well diversified, but they have slightly different ideas about what the ideal global portfolio should look like as a Canadian. This is where you can start to see why neither ETF is obviously better when we look at the geographical weighting. If you prefer a larger Canadian allocation, VEQT gives you that. If you'd rather have more exposure to developed international markets, less Canada, XEQT gives you that. Neither approach is inherently right or wrong. And these differences also show up when we look at individual countries. For example, Japan has roughly 2% more exposure in XEQT, and the UK 1.1% more. Meanwhile, VEQT has considerably more exposure to countries such as Taiwan, China, and South Korea. That has to do in part with the different underlying indices and VEQT's higher emerging markets allocation. Again, though, both ETFs are clearly well diversified by both holdings and geography. So what about sectors? There are some minor differences here too. Can you spot them? VEQT is somewhat heavier in technology, while XEQT has somewhat more exposure to healthcare. But overall, there is a lot of balance between the two. And that's really the beauty of both of these all-in-one ETFs. You're not betting on one sector or one country. You're getting exposure to broad cross-sections of the global stock market. So far, we've established that performance doesn't really separate them, and the portfolio construction differences aren't huge. But there is one area where I personally think XEQT currently has a small advantage, and that's tax efficiency. Many Canadians love income from an ETF in the form of distributions. But here's something that can get overlooked when comparing these two funds. Where the underlying investments are located can affect how much foreign withholding tax you pay. And this does get a little complicated. So rather than just looking at the distribution yield, we need to look at the structure underneath each ETF. VEQT currently distributes annually, while XEQT distributes quarterly. BlackRock's XEQT's trailing distribution yield is currently around 1.6%. Vanguard's VEQT's is around 1.3%. But the yield itself isn't the important part. Not all distributions are qualified Canadian dividends. Some of the income comes from foreign investments. And depending where those underlying ETFs are listed and which account you hold the ETF in, withholding taxes can apply. Bear with me as I break that down. I struggled with this when I first learned about it. For the US portion of the portfolio, VEQT holds a Canadian-listed ETF that itself uses US-listed investments. That structure means US withholding tax can apply in an RRSP and TFSA, while some of the tax can be recoverable in a taxable account. XEQT has a slightly different structure. It has a mixture of Canadian-listed ETFs and US-listed ETFs held directly. That direct US ETF exposure means XEQT can avoid one layer of US withholding tax in an RRSP. That's one small tax advantage for XEQT. Now, let's look at the international equity portion. Both XEQT and VEQT use Canadian-listed funds for this exposure. That means there isn't a second layer of withholding tax in the same way there can be when you have a Canadian-listed fund holding a US-listed fund. And in a taxable account, some foreign withholding taxes may be recoverable through the foreign tax credit. Finally, we have emerging markets. VEQT uses a Canadian-listed ETF that invests through a US-listed ETF, which can create two levels of foreign withholding tax. In a taxable account, some of that second level may be recoverable. XEQT, on the other hand, holds a Canadian-listed emerging market ETF directly, so it does not have that same second layer of tax. So on the tax efficiency front, I think it's fair to give XEQT the win, at least based on the current fund structure. But there's an important caveat here. This is a structural advantage today, not necessarily a permanent advantage. ETF providers can change their underlying funds and structures over time. We've seen that. So I wouldn't choose an ETF solely because of this one difference. But it is a legitimate difference between the two. And this brings us to another area where things have changed recently: fees. One of the best parts of an all-in-one portfolio is that we do almost nothing. We buy it, we hold it, and the fund takes care of the rebalancing. Of course, nothing this amazing is completely free. But competition for our investment dollars has resulted in some great things for Canadian investors. Both Vanguard and BlackRock have reduced their management fees. XEQT's management fee was reduced from 0.18% to 0.17% effective December 18, 2025. Its current published MER is 0.20%. VEQT's management fee was also reduced from 0.22% to 0.17%, effective November 18, 2025. So the fee advantage that may have existed between these two funds in the past isn't really a reason to choose one over the other anymore. They're essentially tied on the headline management fee. Again, that's another reason I wouldn't spend too much time trying to find a single winner. So does this end the great debate? XEQT versus VEQT. Is there a knockout punch by either one? Well, after looking at performance, portfolio construction, geographic exposure, sectors, taxes, fees, I don't think there's a clear winner overall. And that's probably the most important thing to understand from this video. The similarities outweigh the differences. Both have low fees. Both are 100% equities. Both are globally diversified. Both automatically rebalance. And both have an appropriate level of Canadian home country bias. The differences, such as the indices they use, FTSE and Morningstar versus MSCI and S&P, the regional weighting differences, and the way the funds are constructed, are relatively small in the big picture. Plus, those things can change over time, as I mentioned. Even the tax efficiency advantage that XEQT currently has could change if BlackRock or Vanguard changes the underlying structure of their funds as we've seen them do. So I wouldn't say XEQT or VEQT is the better overall all-in-one ETF. Instead, I look at it this way. If you already own XEQT, I wouldn't sell it just to switch to VEQT. And if you already own VEQT, I wouldn't sell it to own XEQT. If you are starting from scratch, either one is a perfectly reasonable choice. If you want a somewhat higher Canadian allocation, VEQT may be more appealing. If you prefer XEQT's regional targets and its current tax structure, XEQT may be more appealing to you. But here's the bigger, more balanced point. The mistake isn't choosing XEQT instead of VEQT or vice versa. The mistake is spending 6 months debating the difference between two excellent, globally diversified all-in-one ETFs instead of actually investing. There is one thing I didn't cover here: risk. If you want a much deeper look at XEQT and VEQT, including their risk profiles, check out my deep dives here.